All right, let's dive right in. Today, we're unpacking a really big one, Abbott Laboratories' Q4 earnings call from January 22nd. Now, this was a report everyone had their eyes on, and boy, when the numbers dropped, the market's reaction, well, it was swift and it was brutal.
Yeah, you're seeing that right. A 10% drop in just one day. That was the market's verdict on Abbott's results and its outlook. So, what on earth happened? How does a massive blue chip healthcare company like this get it so wrong? Okay, so to really get why the stock cratered, we gotta rewind a bit and look at the setup. See, investors weren't exactly rolling out the welcome mat for this report. They were already nervous, and they were watching three key things like a hawk. So here's what was on everyone's mind. First, that lingering pressure in their nutrition business just wouldn't go away. Second, you had the obvious decline in COVID testing revenue. I mean, that party was over. And third, this huge, looming acquisition of Exact Sciences that they had to get right. With all that baggage, the bar was incredibly high. Abbott basically had to come out and tell a flawless story. Anything less, well, it was going to get punished.
And what did we get? Oh, it was a classic case of the numbers versus the narrative. You looked at the headlines and it was like they were talking about two different companies.
Okay, look at this. This is the whole conflict right here. On one side, you have adjusted EPS, the bottom line, coming in at $1.50. A slight beat. Management was quick to point out that operating margin was up a bit too. But then you look at the top line, the revenue, and that's where the wheels just came off. A huge miss. We're talking $340 million short. And just like that, all those pre-call fears, totally justified.
So you gotta ask, where did that miss come from? Well, if we peel back the onion and look at the different business segments, it's pretty much exactly what the skeptics were afraid of.
And boom, here it is. This chart just lays it all out. The weakness was right where everyone was worried it would be. The nutrition business, down a shocking 8.9%. Diagnostics, down 2.5%, mostly because those COVID test sales are drying up. Even though their other businesses, like medical devices, were doing okay, it just wasn't enough to plug the holes. And this is the key takeaway right here. It didn't matter that they squeezed out an extra penny on the bottom line. The market saw this as a total top-line credibility reset. The revenue miss, and especially where it came from, just blew up the whole growth story. For investors, the bull case was officially dead on arrival. So, with the story for the quarter in tatters, what does management do? They pivot hard. They try to get everyone to stop looking at the car crash in the rearview mirror and focus on the road ahead, their guidance for the new year. And at first glance, the full-year guidance looked pretty good. They were still calling for strong organic growth, double-digit earnings growth, the whole 9 yards. But, and this is a huge but, they also guided Wall Street to a really soft first quarter. You can't tell people the year's going to be great while also telling them the next 3 months are going to be rough. That just screams we don't have a handle on this, and it did absolutely nothing to calm anyone down.
And all of that brings us to the verdict. The 10% plunge. It was fast, it was vicious, and a whole lot of people were heading for the exits. I mean, just look at the volume. We're talking nearly 37 million shares changing hands on one day. That's almost triple what they normally do. This wasn't just a few people getting nervous. This was a stampede, a huge, high-conviction sell-off. And to really understand how bad this was, you have to realize the stock was already weak coming into the report. I mean, look, it was already down over 13% in the last month, lagging way behind the rest of the healthcare sector and the S&P 500. So this earnings report wasn't some new shocking problem. No, it was just the final, painful confirmation that things were as bad as people feared. All right, so the stock has been hammered, sentiment is in the gutter, which brings us to our final segment. The Analyst's Next Call. This is where we give you our official Talk Tickers take on what's next for Abbott. So after all that carnage, here's the million-dollar question. What's the trade? Do you jump in and buy the dip, or is this a falling knife you don't want to touch? Here's what we think. In the short term, for Q1, expect more of the same. The market is now in full-on show-me mode. They're not going to believe any promises. They need to see cold, hard proof that the nutrition business is turning around. Until that happens, we think the stock is basically dead money. It's probably going to trade sideways, maybe even drift lower, until there's a real reason to get excited again. And because of that, our rating on Abbott is pretty straightforward. It's an underperform. We just don't see how this stock can keep up with its peers or the overall market until it gets its house in order. There are just too many operational issues, and frankly, a major credibility gap to fix. And, as always, please remember, the analysis and opinions you heard here are for informational purposes only. This is not financial advice.